Recently, an investor called out that he thinks HIM stock has 100x potential. He details the case on Twitter, and then you don't see this every day. The CEO responds saying, yeah, I don't disagree with any of this. Excellent summary. So the CEO supporting the 100x cause, I guess, of course he is. And you're looking at the stock year to date up nearly 50%, a large jump in response to their favorable earnings developments. We're going to talk about that in just a second. I previously have covered HIMS in several different videos. Back when that was a SPAC as Oak Tree Acquisition Corp. I previously did own it as well. I also bought the warrants as well. The warrants worked out up several 100% during the time period that I called it out to my subscribers at Unrivaled Investing, and I'm no longer involved in it. So I wanted to review, where they're at, how they're delivering, and it is worth calling out the management caliber here, because unlike most SPACs that said, hey, we're going to do this, they actually delivered. They delivered very solid results, and as you look at these results, it's honestly quite impressive. Subscriber growth, 48%. Revenue growth, 47%. These are the most recent figures. I mean, they previously were putting in much more conservative expectations. This is also a chart, relatively new, what I like to see, showing how they're doing relative to other telehealth providers and that they are taking market share over time. I love to see that. That is a sign that you're doing something that's right. You're winning market share. I'm seeing that their gross margin profile continues to expand from mid 70s to, low 80s%. Once again, you're either cutting costs or raising prices, selling higher margin goods. This is what I like to see. Next up, as you see the impressive gross margin expansion, you've seen they've levered their expenses with improved profitability, showing consistently improving EBITDA margins. This is what I want to see with a business, showing, hey, we're getting to free cash flow positive. Yes, there's a lot of stock-based compensation, but they're heading in the right direction. Not only that, but they're also saying we have a lot of opportunities. Not only, yes, we have a background in ED pills and men's dermatology, but there are all these other verticals that each represent $100 million markets for us. Women's dermatology, mental health, weight loss. Each of these could further, drive and significant growth in the years ahead. Management's quick to call out, yes, we have a payback period of less than 1 year. So we acquire customers. Yes, we do spend a lot on marketing, but generally, based on the products that they're subscribing to, we get some sort of positive economic return within that year. So even if churn's a problem, don't worry about it. And they're expecting not only have they delivered strong growth, but they're expecting continued strong growth in 2024. Given management's history, you might even say perhaps this is conservative. We'll see. They're saying 34 to 38% growth for fiscal 24 and continued margin expansion to 100 to 120 million in adjusted EBITDA. That adjusted EBITDA does include stock-based compensation, but you are seeing that the trend is your friend with at least their results here. And looking at their long-term expectations, once again, full credit. I really like that they've penciled this out for, a couple of years now. They think their long-term adjusted margins could be 20 to 30%, and they think their gross margins could be mid-70s. So that means they do think gross margins could come in a bit in the future, but profitability could more than double. What are my personal thoughts on HIMS? First of all, in full disclosure, this is not financial advice. Also, quick plug, recently an Unrivaled Investing subscriber posted in our exclusive Discord that I've recently paid my second annual subscription and couldn't be happier. I've profited enough already to cover the next 20 years of subscriptions. It's not hyperbole. I actually did the math. That's a direct quote from the exclusive Unrivaled Investing Discord. I do try to keep the prices affordable, so that way as many people as possible that are interested in learning about sizing up individual companies or learning for themselves, they easily can join. I hope you consider it at unrivaledinvesting.com. So looking at HIMS, part of my concern is the churn. And they previously did have some slides that they stopped reporting. And that has been with a consumer subscription business. That is a key aspect. And it's not helped by looking at some of the online reviews. I really don't like to see on Trustpilot that you got a lot of, on average, it's a 3.5. Looking at other sites, I think it's called Product Hunt, mostly 1-star reviews. These reviews suggest that a lot of people don't like the products or they had a hard time with customer support. That's at least my own reading of the commentary. I don't like to see that. I'd rather see something where the product reviews are outstanding. Management's quickly saying, look, we are transitioning to this personalized medicine with unique and effective solutions at compelling prices, where around 30% of their solutions are personalized. The reason why this is important is the idea that, hey, if we sell things that are personalized, it's harder to be disrupted. You're not just selling generic goods. The part that's a little tricky here is they're talking about weight loss subscribers utilizing a personalized option. The reality is, if you double click that, it really just leads into what I believe are a bunch of either generics or possibly even branded drugs, but it's not like, it's truly a unique prescription or medication that you're getting. It's more like the dosages or customized to who you are. So that doesn't really strike me as special. Either way, they're saying it's around 30% personalized. That means around 70% is sort of generic. So let's look at this business. Let's look at this. And generic I'm using loosely because you could also get prescribed a branded drug that's not theirs. But looking at this business, and I think this is the key heart of the financials that's worthwhile to understand, there's an 83% gross margin. That means they're selling products for $42 million that they're marking up by 5 to 6x. I think it's only a matter of time before someone like Amazon Prime comes in and just really pushes on their telehealth solution and says, your margin is my opportunity. And there's no reason that this shouldn't be 30% or 50% over time. I just don't think it's going to be 80%. Management clearly doesn't think so either. And that's why they're saying 70% long-term. But what's to stop it at 60% or 50%? What do the economics look like for this business? If I were in Andrew's shoes, he's the CEO. Yes, I would be running a very similar playbook, which is spend as much as possible on marketing, running, a reasonable cash accretion, not really cash burn at this point, but because they're stock-based compensation, but spend as much as possible on marketing. So that way you slowly build a loyal customer base that will stick with you. But the problem is there are already customer bases that are much, much, much bigger, like with Amazon Prime. And so that's the tricky part that I have looking at this. When I look at AI Ticker Chat to ask, well, how can this perform over time, providing a range of growth, a range of profit margins and multiples, it's suggesting, arguably a more conservative take than I personally would have, suggesting 50% downside and 200% upside over the next 5 years. My own personal, view as I think about the financials is that, AI Ticker Chat, I think was a little too conservative on the margins. I think their margins could be higher over time, but there's also this risk of competitive disruption that I don't think ultimately when you're selling 70% of your products aren't truly a proprietary solution. It's going to be very hard over a multi-decade perspective, multi-year perspective, to maintain 80% plus margins. I don't see it. Maybe I'm wrong, but we'll see. That said, if they aren't disrupted and if they continue to execute, and they're growing very quickly, if they continue to execute, I'd argue they do have significant upside, maybe 200, 300% over the next 5 years. Do I think that HIMS is a stock that has 100x upside potential? I personally don't think so. I think it has a lot of potential, but I also view it as facing a lot of disruption. It faces a lot of risks over time. I think the business model needs to evolve over time as it faces these realities of consumers going, wait a second, do I really want to pay 5x markup on this product? So I don't think so. But overall, as we've seen, if they continue with exceptional strong execution, which is possible, got to give management credit, then the stock could work out very well. I personally just think that there are other easier plays out there. I've personally called out one of my top holdings here on YouTube, Fairfax Financial, which you can check out those 2 videos as well. I hope this video on HIMS has been helpful for you. And hopefully if you're a HIMS shareholder, this works out. Hopefully, it continues to do well. I just, it's too hard for me personally, and I'm okay missing it. Maybe it does go up several hundred, maybe it goes up 1,000%. It's just, there's an aspect to this business model evolution that gives me a little bit of heartburn. If you have a different take, would love to hear it. Thanks so much for tuning into Unrivaled Investing.